All right, well, thank you. Welcome to those that are on today, and for those who watch this later when it's being recorded. We had a great opportunity on Saturday to be live in front of Next Vision folks to talk about the Index Universal Life product and try to get you a little more comfortable with that. So today we are actually going to work on what an illustration looks like for the IUL, which is different than the GUL illustrations that you're running. So we're going to go ahead and get started. If you're not contracted with Columbus Life, you will need to contact me so that we can, make sure that you get your appointment through Casey through Next Vision done, and then we can get you set up on the website so that you're able to illustrate and or sell the Columbus Life products. And if you are appointed but aren't really sure how to get logged onto the website, that's something that I can help you with as well. So we're going to start right off the home page. So when you get logged into the website, first thing it's going to do is tell you welcome and your name. It'll give you my contact information as well as David's when you're logged in. And from this blue bar here at the top, we're going to go to Write Business and Illustrations. Everybody can see my screen okay? And you stop me if at any point in time something doesn't actually move along with me. So on this particular page, you have your life products and annuity products. You do have the option to do this download. You really don't want to do that. It limits my ability to help you with an illustration. And it's also a little more cumbersome because the products have to be updated on a monthly basis. And it's just like a cumbersome desktop software that most of you probably won't need to put on here. But so what you're going to do is use the launch web version. This software is called Life Portraits. Most of you, if you're selling our GUL product, you automatically already have access to it and are already running your illustrations. But for those of you that have not been selling Columbus Life, it's pretty simple to start with. You're just going to start with create your client. You only have to input the information above the blue bar. So just your basic, some name in the fields, age or date of birth, gender, and state. So we'll do Minnesota. When you go to run your action and new illustration, you're only going to have a couple of drop downs here. You're going to have your GUL, your Voyager, your IUL, and our Explorer Plus. I, of course, have like many, but we'll go ahead and run it right here with the Index Explorer Plus 2019. And this is the default on the page. If you're having another agent run an illustration, you can change the agent's name on the illustration just by clicking on the pencil sign here at the top, just so that you know. And then automatically it's defaulted what you input on the first screen for the product, the state, and the client's name. The default for the rating class is going to be standard non-tobacco. And we, of course, have 5 rating classes on our permanent products, so 3 non-tobacco and 2 tobacco. And then if you had a substandard, if for some reason you thought your client was going to have a rating, or maybe you're trying to run an illustration after you get an offer under the substandard rating is where you would change that if you need to add a rating class. And typically you're going to leave the illustration type as new and qualified doesn't apply. You should never be running a qualified illustration. That really is for us at the home office. So scrolling down here a little bit, just so that you kind of know, we're going to kind of walk through the tabs, but this is called the policy detail tab. So this is the page that you're putting most of the data into the fields. There is a writer page. We'll touch on that, cash flow values, and then reports, so that you see that I'm on the policy details page. On the type of illustration that you would normally run, when you're running a Voyager illustration, even though it defaults to this input all parameters, normally you're probably running it as a solve for premium. So your client wants a $100,000 face amount, you're going to solve for the premium, and you get to choose which lifetime guarantee, which guarantee you want on the Voyager, the 90, 95, or 120. So on the IUL, you have a few more options that you actually are going to probably use more frequently than you would use on a GUL. So you can still run those solve for premium illustrations or solve for face amount illustrations. So for example, in the event that you have a client who you had quoted them on the GUL, maybe instead of super preferred, they got standard, and now the premium seems a little high and they're rather young. You might actually jump over and end up having the case issued as an IUL simply because the premium is probably less expensive. So the difference here when you go to solve for premium is instead of you getting an option here to solve for your no lapse guarantee of 90, 95 or lifetime, you get this grayed out box here. And so this is just telling the system, tell me how much the premium is for a $100,000 face amount if I want it to be monthly. And so pretty simple. I didn't change anything else for that solve for premium illustration. I left the death benefit level. I haven't changed anything on the allocations. I'll show you that momentarily. SCR is something that's not available on the Voyager, but is available on the IUL. And we're going to kind of skip over that today. It's a little more complex. But then everything down here is defaulted. So you're going to leave these defaults under the solve criteria, interest basis, cash value, and target. So that was it. If you just want to find out what a level lifetime premium is on an IUL in comparison to a GUL, that's all you're going to do is solve for premium. And then you can preview the illustration. And this is where it might not jump for me. So David, are you able to see the illustration coming up?
Not yet.
Okay, so then I'll have to jump on that. So let me change my screens. One of the pitfalls to using webinars. Can you see the illustration page yet?
We see the happy family. So yeah, we're
all
good.
Right, very good. So that's the illustration. So on the IUL illustration, there's a default that adds this, I call it the pretty pages on the first 5 pages of the illustration. But then as you scroll down, you actually get to the PDF of the illustration. So just like your Voyager illustration, when you get to the actual illustration, the top left-hand side is going to tell you what the premium is. And again, this was just a simple solve for premium. This is not a cash accum case. This is just a traditional life insurance solve. And you can see the model premium there on your top left-hand side. And then just like the GUL, you can see your target premium, which your commissions are based on, down on the bottom right-hand side. And just like with the Voyager, one of the things that you're going to notice is that typically your target and your solve for premium are the same. Whereas on the index product, it could potentially, your target premium is likely going to be different than the target premium, or the target premium is going to be different than your plan premium or your solve for premium. So not to get too confused by that, I want to try to keep this kind of high level today, but just know that your target is still down on the right-hand side. So that, I'm not going to go through this illustration here because this is just a simple life insurance solve. But I wanted to make sure that you knew that you could do that type of illustration or that type of case using the index product, very much like your traditional UL or your UL. So same thing, you can reverse search and do solve for face as well. So if your client says, I have $200 a month in premium, how much life insurance can I buy? You're going to be able to do the same thing. So upside, probably need to jump back. Yeah, and so somebody needs to mute in the background. We hear somebody coughing and sneezing. So if you don't mind muting yourself. And I'm going to change my screen again back to the illustration software. Make sure you can see that. Sorry about that. So I jumped over here to the illustration software, and basically instead of solving for premium, I jumped up to solve for face amount and showed you the opposite. So if your client says, I can afford $200 a month, how much insurance can I get? You can do the reverse search. I'm going to try to look at our participants and mute everyone because we were getting a lot of feedback there. All right, I think I fixed that. Sorry about that, folks. So that's your simple illustration. IUL, solve for premiums, solve for face amount. So now we're going to talk about a cash flow illustration. So again, your default on these pages are, well, I thought I muted everyone. Let's look one more time. It looks like everyone's muted. So again, we're going to try to focus on the cash accumulation. So if you were with us on Saturday, we talked a lot about the flexibility of this product and how you can use this product to grow cash accumulation, and pay it for shorter periods of time, it just to retirement age, etc. So that's what I want to show you today. For some reason, my screen, there it goes. So let's talk about this client. One of the things that I talked about on Saturday was, so I'm going to make this client a little bit younger here. I'm going to dial her back to 35. One of the things that I talked about on Saturday was the ability to use this product or use this policy for the life of the agent or the client, so that as they are younger and starting out with the protection plan for their family, as they age and transition, they can actually change this product to accommodate the changing needs in the family. So let's say this particular female at 35 is preferred non-tobacco. She's just starting her family, needs about $250,000 of life insurance. Really, at this point in time, just needs to cover the life insurance. She really can't max fund the contract yet. So we're going to try to just have her fund the premium on the policy right now, just to provide some protection for her. But we're going to make this an increasing death benefit, and we're going to assume right off the bat that she's only going to pay the premiums to 65. So let me kind of back up here a little bit and show you what I did. I changed this to input all parameters. I made the face amount 250,000. On the index product, if it's affordable by the client, we typically want to use the increasing death benefit as long as the client is paying premium. So I did option 2. Basically what that does is give us more room to put more money in later. I ran premiums to 65. And then I turned off the option 2 when I'm going to show them stopping paying premiums, and then changed to level death benefit. That is a manual change. The system, it doesn't automatically happen. The client or the agent will have to make the changes. In this case, I solve for target premium because right now I just want a premium to carry. Remember, I only want premiums to go to 65 because they're going to eventually use this as a supplemental retirement package. And I'm going to leave it monthly, which is PAT. And I'm going to leave it at guideline premium testing. We're going to leave the prevent MEC box checked. We don't want this to become a modified endowment contract. And pretty much everything else is going to stay the same. I do want to show you the allocation options. We're not going to dig into this today. We did cover it on Saturday, and I'd be more than happy to show you where some training is on the website that'll touch on this a little bit more. But our default on the index product is a 0% floor and 100% capped. You can see here that if I change these allocations, if I decide to do like 50% capped and 50% uncapped, it took my illustrated rate from 6% to 5.11%. And that's because right now our spread is very high on the uncapped account. Again, I'm not going to dig into that today. If you're just getting introduced to the IUL, using the capped account is completely fine. That's usually where most of the producers are putting their funds right now anyway, given the volatility of the market. And it will illustrate at 6%. Should you want to illustrate it more conservatively, you can always put a lower illustrated rate in here, but you can't make it any higher than what the approved illustrated rate is. So we're going to leave this at 6%. And we're going to look to see what this case kind of looks like. So before I do that, though, I want to walk through some of these tabs. So most of the riders that are available on the GUL that you're familiar with are also available on the IUL. So it automatically is going to have your living benefits in most states your accidental death benefit rider, child rider, disability credit rider, insured insurability, and other insured term riders are all available on both of the products. The enhanced cash value rider is available only on the IUL. However, it really is only used if your client is going to be dropping in a significant amount of money early in the contract. So that's really for premium finance cases and larger policies, typically in the 5 million plus range. So it's really not a rider that you would need to understand or know about until you have one of those cases, and then we can chat. We're going to skip the cash flow tab now. We're going to jump down to the values tab. The values tab is going to give us kind of a preview of the illustration instead of me having to pull up the PDF. So if you jump to the values tab, you have a couple of important numbers here that are at the top of the page. We already know the product and the rating class. When we talk about max funding a contract, this guideline level premium, and in this case it's 9505, is what max funding would be the way that I set this contract up, with a $250,000 face amount and an option to death benefit. As you can see here, we actually are only starting the policy at $2,500. So we're just basically buying life insurance right now. So with just that target premium, if I just scroll down here and look at the premiums, I've paid in premiums to age 65. At age 65, I have about 140,000 of non-guaranteed cash value, and my death benefit has grown to 392,000. If I never take any money out of this contract and I just leave it sit, it's going to stay in force, and the cash value and the death benefit are going to continue to grow, which means the living benefits are also growing. So that's just the simple $2,500 a year target premium. So that's like about $200 a month, a little more, that's going into this contract. He only pays the premiums to 65, his coverage for life, has some nice accumulation, could potentially borrow from it, but it's not overfunded. So therefore, he kind of is limited as to how much of that cash he can get to, because we didn't actually overfund the contract. So now let's go back to this illustration. And now let's talk about a cash flow illustration. Maybe this client now is older, and we're going to make some changes. His debts are starting to be paid down. His income has went up dramatically, or her, I keep saying him, her income has went up dramatically. Maybe children are grown or about grown. Of course, I'm going to leave this at 35 so you can see the long-term effects on this. But we're going to change the premium on this contract. So we're going to say he paid target premium for the first 10 years, which we said was a little over $200 a month. We're going to go, let me go back. So I'm going to show you what I did here. I went into this little bar graph here, which allows you to make changes to the layered premiums. You can layer them up to 10 layers. And I'm going to leave it at target for the first 10 years. So till he's 45 or she's 45. And then I'm going to change, if it'll let me here, change the premium. I'm going to change this back here and put this at 200. For some reason, it's not letting me change it. So that's why I wanted to put in the number. All right. And now remember that number we had the 990, 9,600 or 9,000 for target. Or let me go back and look at that. I don't remember. For the max funding. I'm going to pull up my calculator real quick here. So max funding is 9,500. So let's say now he wants to max fund this contract because he wants to see how much money he can grow in the contract. So before we've max funded it, let's somebody write down this number. At 65, oh, that changed the premium, sorry. I went back and changed it to 1,000. It was like 140 something. So I'm gonna go in here and I'm gonna change this premium. We'll just do $700 a month starting at 45 to age 65. So when he had children in the first 10 years, or maybe even 15, he can keep the premium relatively low. Now he's going to pump up the premium because he's decided he wants to use this for income stream. I forgot to push this little button here, but this button here is the max cash flow button, is going to give us a cash accumulation case. So I'm going to put my 250 back in here. Everything else will stay the same. When you push this max cash flow, it automatically assumes premiums are going to be paid to 65, and it turns on the income from 65 to 85. It's going to put this extra field down here for solve criteria, and the default is maximum interest assumed and then target age of 120. You will want to leave that alone because you want the policy to stay in force anytime there's an outstanding loan on the contract. And we're going to take loans here as a cash stream, as a retirement income stream. So, and the default is the index loan here. And again, I'm not going to dig into that today, but that's a default. So you can just leave that. So if you're not sure you should be changing it, you probably should not be changing it. So let's kind of back up over what we did. We hit the max cash flow button. We're still doing the $250,000 face amount with an increasing death benefit to age 65 because we're going to pay premiums to 65. We're going to leave the default allocations over here, so I'm not changing anything on the allocations. We layered the premiums, so I took the premiums up when he hit 45 because he decided that instead of just paying the minimum to keep insurance, he now wants to max fund it. He's only doing that to 65. We added this default to show income stream from 65 to 85, and we're pretty much done. So I'm going to jump again to the illustration. I'm gonna have to jump screens too, I think. So let me do that. Can you see the illustration page? Tell me if you
Yes.
can't, somebody. Okay. All right. So again, we have the pretty pictures here. So now these pretty pictures become a little more valuable because we changed this to an overfunding or a cash accumulation strategy. So one of the things it talks about, I like this little tree because one of the sales ideas when you use this particular document in front of your illustration is it's easier to read and explain to the client and less complicated than the numbers on a ledger, but it kind of draws the picture for the client. So most people purchasing life insurance, especially the GUL, know you pay your premium, you purchase life insurance, somebody's going to get the death benefit. So you're purchasing it primarily for protection, maybe secondarily for the living benefits, which still apply here on the index product. But on the index product, you've also added this extra option here of supplemental income. So basically, when you're buying this life insurance at this age 35, they probably need the protection. They probably have a lot of debt, small children, big mortgage. But as they're aging, those needs are going to change. So the next stage that we're going to look at is the supplemental income stream, how the client can get money out of their life insurance contract once they get to retirement age to supplement what they might already have in their retirement assets. So I kind of like that tree to describe that. And if you scroll on down to the next page, it kind of gives you a picture at different ages of the values in the contract. So I ran this in Minnesota, so that's why it's showing nursing home here. In a lot of the other states, it's going to just be called chronic illness. So looking at this here, at age 55, they had about 146 in cash value. Not very likely to have a living benefit claim during that time frame. If they died at that time frame and had not taken any cash, they would have their 250 now is worth 396. Excuse me. At age 65 now, this cash value has more than doubled in the last 10 years. Living benefit claims have been enhanced. And again, their death benefit is continuing to climb. Now, this is the point at 65 is when I leveled out the death benefit. So I went from option 2 to option 1 because we're no longer putting premiums in the policy. Now, these numbers don't show any withdrawals or any claims. So assuming the client has not touched the policy and they get to 85, they potentially have 1.2 million in cash value and or living benefits. A little more than that if they leave it or they don't access the benefits or the cash and they die, we're at 1.3 million. And they only paid the policy to 65. So it doesn't really show you the income stream there. That's just that they left the cash alone. So now let's scroll down and look at the illustration a little more detail when we get down to that 65 and the cash, and we're going to start cash flow. So remember, I changed from option 2 to option 1, so that'll have to happen. You'll want to stop premiums, so that'll be a responsibility of the client or the agent. And then you'll have the ability to turn on the income stream. Now keep in mind, this is a hypothetical only illustration, but it should be a pretty good synopsis if your client leaves the money in the contract for an extended period of time. And in this case, we're looking at 30 years before they stop paying premiums. So I'm scrolling through a lot of the complex IUL illustration, which is far more detailed than what you're used to seeing on the GUL. And we can dig into that probably another time if you'd like to review the illustration, but I just want to show you the highlights here. So first of all, different from your GUL illustration, there are 3 sets of numbers. There's the guaranteed or the max cost of insurance based on a 0% return. So this is that scenario that's never going to happen. We're never going to have a lifetime, of 30 plus years of a 0% interest or max cost of insurance. Columbus Life has never raised their internal cost of insurance. It doesn't mean it can't happen, but they haven't at this point. So when you look at this first set of numbers, you need to tell your client that if we actually have a 0% return for 30 years, we have a lot bigger problems than their life insurance product. So over here on the far right is what our real goal is. That's a 6% non-guaranteed illustrated rate. So when you look at the illustration here, you can see here, basically, we're assuming the client is getting an average of a 6% return, and how up to 65, the death benefit's continuing to grow. So we're going to keep scrolling down here and show you what happens at 65 and thereafter. So we're flowing through here, still paying our premiums, clients pretty much max funding it. And now we're 65 years old. At 65 years old, he's paid in $195,000 over the course of 30 years. If we've averaged the return of 6%, he has a cash value of about $372,000 and a current death benefit of $622,000. So this is where we're at when we stop paying premiums and we start to take an income stream. When we're taking loans on the contract, if we're taking participating loans, the money continues to work for the client, even though they're doing withdrawals from the contract. So you see here in year 31, age 66, we've started an income stream. So 35,000 ballpark a year coming out of the contract. It is impacting the surrender value and the death benefit. Those will start to go down as the loan grows. But you can see here that we basically take $35,000 a year. Certainly a nice supplement to whatever other pension or retirement stream or Social Security that they have. And at the end of the 20 years, assuming this is how they, if they're still alive at 20 years, or if they need to continue income stream or spread it out, very flexible. But assuming that we're now 85 years old, he paid in 190, if she paid in 195,000, she's withdrawn 700,000 in cash. Contract still has about 11 grand in it at that point in time, with a death benefit of about 75,000. If she's no longer taking cash out, or we didn't cause the distributions to maybe go out over a longer period of time, then the policy has the potential to continue to start to grow again, and could potentially still be used, whatever is left in the contract, for a living benefit. If you have a living benefit claim and you have an outstanding loan from an income stream, they're going to calculate the claim benefit and then deduct whatever the current outstanding loan is at the time of the living benefit claim. So now we're going to keep scrolling on down here. They took over $700,000 in cash out. They lived to be 95. At 95, when they die, there's a potential that the death benefit is already back up to $211,000. Now, notice the middle columns. Remember, I said don't be too concerned about that first column, because if the S&P returns at 0 for 30 some odd years, we have a bigger problem than just a life insurance contract. If the contract only earned a non-guaranteed interest rate of 3% for the life of the contract, it runs out of money here at age 72. But again, that would be a very, very conservative interest rate over an extended period of time using the S&P. The historical performance on the S&P is somewhere between 6.5% and 7.5% over any given period of time. And so illustrating at 6% is very realistic long-term. And then, of course, just like your GUL, at the end of the illustration pages, you're going to see your living benefits. These living benefits are not taking into consideration the fact that you actually took withdrawals or loans out on the contract. So if I can get there, one more page. So these numbers that are on here are assuming, just a traditional plan that you've paid premiums to 65 and the cash accumulated, but no withdrawals or loans are outstanding. So pretty simple there. Let me close out of this. And go back to my screen. So again, that's basically how you build the cash accumulation case. So let me start one from scratch here. You go back to the Home tab. I'm going to build a more straightforward cash accumulation case scenario. We're going to build it a little bit differently. I use a 45-year-old male. And I'll stick with Minnesota. So this scenario is going to be a case where the client comes into it from day one, wanting cash accumulation, and they're not concerned about the death benefit. Reality is this is probably the most common IUL case that we would sell, but I did want to make sure that you knew that we could meet the protection needs of the client. So here we have a 45-year-old male. He's come to you and he says, I really like this whole IUL concept of building some cash that I can put into the contract. Right now I can afford $255 a month. I want to be able to pay this in until I'm 70, and then I want an income stream until I'm 100. So what parameters? And he's not concerned about the death benefit. He doesn't need the protection. He really just wants to take advantage of the accumulation. So we're going to start here by hitting this easy button. I call it the easy button, the max cash flow button. It's going to default to the minimum face amount. It's going to default to the level death benefit. But remember, if we want to max fund this, if we want to get this face amount down a little bit lower than a level death benefit, we can do the option 2 while they're paying premiums. Remember, I said in this case, we're going to pay premiums to 70. So we're going to do option 2 to 70, and then automatically default to level death benefit to age 120. We're going to leave it here at minimum. We want the lowest death benefit we could possibly get. We know he can only afford $250 a month. It defaulted to 65, but I'm going to change that to 70. I'm going to change him to monthly. Of course, it can be any premium mode. We're going to leave these items here alone. And we're going to show his income stream from 70. Again, I put the defaults in, so you have to change it. 70 to 100. Again, I'm going to leave the target age and everything here the same. So I'm done. I hit the cash flow button, minimum face amount, option 2 to 70, premiums to 70, loans 70 to 100. So rather than jump to the illustration, I'm going to show you how to see that on the values tab. Now, I do need to make one comment first, though. When we run a policy at minimum, if he called in a few years and said he wants to increase the face amount, he will not be able to increase the premium. He won't be able to. So if a client truly wants to be able to put more money in later, then you're going to have to either illustrate that by layering the premiums or just up the death benefit from the very beginning. Or like in this case, if you think this client can qualify for preferred or super preferred, you're simply going to start the face amount at 100,000, and that's going to give them a little more room to put some more money in. So here we just did the $250 a month to age 70. So you can see here 3,000. Remember, I told you this guideline level premium up here, that's called max funding. That's the important number on this illustration. The target premium is 1,160. So just a quick explanation of the way that works. You get paid on the lower of the target or the plan premium. In this particular case, the target premium is lower. So you're going to get your first year commissions based on this amount. And then everything your client puts in over and above that amount, you'll receive overfunding commissions. On this product, you also receive a renewal commissions and total of assets under management. So you're basically getting paid on this, on the premiums inside of the IUL multiple times. So if you keep the policies in force and build a business of IUL business. So let's scroll on down here. Remember, this one we ran to 70. So he paid in $3,000 a year for 25 years. And starting in, which is way less than that other illustration. Remember the one I ran before was like 9,000 that he was putting in a year. $3,000 a year for 25 years. And also I ran the distributions for 30 years. So I ran the distributions to 100. So he's getting 11,000 a year out to age 100. And then there's still some death benefit and cash value if he's still living at that point. So if I jump to the illustration here, and I just want to show you the numbers at 70. So I'm just going to jump down to that page. Right past 70 here, because I want these totals. So we paid in 75,000. We start this distribution of 11,700 at age 100. Just keep going here. So it gives me the totals. At age 100, he had paid in 75,000. He got out 352,000, and he still has an $18,000 death benefit. So again, that was a little bit different than the original illustration that I ran, because on the original one, we needed that base amount first. We needed protection and we needed cash accumulation. And then he changed his strategy midway. On this one, we just ran a simple 250 solve for minimum face amount. Now I mentioned, maybe he thinks he's going to qualify for a super preferred rating. So that minimum face amount is 100,000. You can simply change that to 100,000, leave the option 2. That will give him a little more room to put a little more money in down the road. So even though he's starting out at $3,000 a year, he could potentially double his premium, because that max funding here is $6,100 by me bumping that face amount up just $100,000. So it leaves him a little more flexibility in the contract. So I am ready for some questions. Looks like we have like 14 people on the call. So if you don't mind typing in your question on the chat, I'd be more than glad to either illustrate that or show you where it's at or answer your questions for you. And I love questions. So even if you think it's a dumb question, somebody else probably has the same question. So please go ahead and ask it. Case, Johnny, throw me some questions.
Can you hear me now?
I can.
Oh, good. One of the things when a client looks at the illustration, I always like to say this one. In fact, if I send anything out to the team, to Next Vision agents, I always say with an IUL, the best thing about it is the annual report. Because what you get to do is you say, well, what if S&P doesn't hit 7 points every year or whatever the number is? Well, we get to check that every year. And what we do is we take the annual report. And the annual report will show whatever your limit is, because it's higher than your 6 or 7 points now every year. In fact, if the index shows 8 or 9 points, you're going to pay 8 or 9 points. But if it shows 0, you're not going to pay anything that year. But look at the historical record. And I would take the client back. Let's say it was a bad year. And I'd say, look what the last 20 years has done. In this way, you can answer a question. I even like to answer this question before I ever get it with the client. So now let me show you something we do, and you're going to love this. We get to review this every year, and we look at it. I'm going to show you what it did this year. And in a good year where it bumps higher than what you illustrated, you're going to say, isn't this great? And you talk about putting more money in that other plan. That would be a good excuse if you had a good 10 years and you had the option where you could put the money in the 11th year too. You could say, look what we've done the last 10 years. Do you want to put some more money in? And he probably would say, hey, I love this product. And the other nice thing about it is if it's doing poorly, your guarantees are higher in that first 10 years. In other words, they're good. It goes down in the latter years. So if it did market look bad for 6 or 7 years and scared the hell out of the client, you could say, maybe it's time to move, but we'll take the cash that's in there because it will be, at least 50, 60% in the first 10 years. So anyway, that's what I do is I always sell the annual report.
Sure, and I think it's really important that you're doing annual reviews on anytime you're selling an index product. You do not have to be securities licensed. It is a fixed product, but it does need a little more monitoring probably than a GUL. You can reallocate inside of the contract at any given time, either by calling client services or submitting a form. So right now, for the most part, our cap is 9.5. Somebody asked that question. So right now our cap is 9.5. On our cap, the annual point to point, all of these are S&P. And on our uncapped point to point right now, though, our threshold is 15. So currently, your client is going to be in a better position inside of the capped account. But I'm going to show you some historical numbers here in a moment, thanks to Johnny's input there. And you can see here where if you had if the S&P returned at 20%, right now with a 9.5% cap, your client would get 9.5% here. And the spread account, they would only get 5% because the spread, they don't get the spread amount. So right now the cap looks great. And I mean, who's going to complain about 9.5%? Also, you have the ability to reallocate a portion of the funds into our fixed account, which is currently paying 4.2. And in the 11th year on this contract, you automatically get a 0.5 basis point added to the contract. So that's regardless of the policy performance. So let me go back out here and show you one more thing on the interest crediting history and on the S&P. So make sure that you can see my screen. I think you can. So this is our index crediting history. I'm going to see if I can make it a little bigger. So, and it shows what you're seeing here is how the cap changes. So a beginning date and an end date. So the 15th of the month is our sweep date. And so every month on the 15th, we declare a new rate, new cap rate, new spread, et cetera. It may or may not change from month to month if we really don't see that much fluctuation in it, but it has the potential to change prior to on the 15th of every month. So what we're looking at is where the S&P was at. So if you look at this here, let's just go back here to January of 2020, pre-COVID. The S&P on January of 2020 was 3289. So where's the S&P at today? I mean, it's definitely up over 4,000. So here in January of 2021, when the index ended at 3768, our cap rate right then was 12% instead of 9.5. The S&P returned at 14.56, so the client got the whole 12%. Over here on our spread account at that given time, the client got 8.5%. So let's go down, a year later, let's go down to January of 2021 to January of 2022. Well, in January of 21, the S&P was at 3768. In January of 2022, it was at 4663. Another substantial climb. 23.74%. On the capped account, our cap then had went from 12 to 11. The client would have earned in their whatever money they had in their account value, 11%. And then over here on the uncapped account in that particular spread time, they would have earned 8%. If you're looking at these numbers here, you can see that, I mean, at least over the last 2 to 3 years, there's been almost nothing under 6%. And that's what our current illustrated rate is. So that's just looking at what the S&P has been doing. If you jump back into your illustrations, try to close this out. Anytime you're doing these, there we go. Webinars, there's all these screens show up. So I'm going to show you, jump back into the illustration, and on page 13 and 14 of an index illustration is the historical performance of the S&P. So if your client is asking you questions about, you know, what is the S&P really performed? And this is on page, over these screens, 14. So on page 14, it's going to show you what the historical performance has been, basically how the S&P has moved and what we contributed that year based on how the S&P performed in our caps. And these, we only go back to 2014. They show you what would have applied based on our current interest rate or our current cap rate back to 2002. But this contract has only gone back to 2014. And then if I scroll back up to page 14, this is one of my favorites. This shows you the average return from 2017 to 2021 on the S&P was 16%. 2012 to 21 was 13%. 2002 to 2021 was 8%. 1992 to 2021 was 9%. So showing your client an illustrated rate of 6% is very, very realistic. Are they going to have zeros? Yes, I guarantee you some 0 years. But historically, the S&P is going, you know, has averaged far and beyond that. I have another question. How does the uncapped rate work with the spread? So what happens on the uncapped account is right now our rate is a 2% threshold and then a 15% spread. So if we use the example where we had a 20%, if the S&P was up 20% in a given year, right now with the client, we get the first 2%, the company would keep the next 15, the client would get everything over those 2, which is 17. So at 20%, he would get 5. If the S&P returned at 30%, you basically subtract out that 15, the client would get 30 or get 15. So right now, because the spread is so high, pretty much no one is using the uncapped account. When it was down at 5 and 6 or 5 and 5, then you had a lot more opportunity in the uncapped account. So if it was 5 and 5, 5% threshold, 5% spread, 20% return, you just deduct your 5% and the client would get 15. So, you know, really right now, just because the volatility of the market and the stock market has been just crazy overpriced for the last couple of years. That means those of us that are invested in fixed assets, and this is a fixed asset, are struggling to try to keep up with the stock market. So, you know, just a reminder, you're not actually invested in the S&P here. You're actually invested in the Columbus Life and their ability to invest your assets. And it's running parallel to the S&P 500 index. You're not truly in the index. And so that risk is removed from your client because they're not really in the index. They have a floor. They can't really lose money. They can only gain money. They still have policy expenses, of course, that come out even in a 0 year, but they're not going to have a negative return.
Hey, Sandy, one point. I love the numbers, but I love that tree. You know, most people think a life insurance policy, you buy a life insurance policy and you're going to get a death benefit.
Right.
But that tree spells out the other 4 benefits. I think that's beautiful because they're all familiar with the money tree.
Yeah, absolutely. Is it different than what you're selling on the GUL? By all means, yes. Is it right for every client? No. Is it the hottest product in the market right now? Yes. I can tell you that on a day-to-day basis, we probably write at least 5 or 6 to 1 IUL over any other product right now.
But when they look at the tree, it's sort of an eye opener for the client. They say,
It is. I mean,
okay.
it does. And the
That's
flexibility. I talked about, you weren't there on Saturday, Johnny, but we talked about the flexibility of the IUL product. It just offers so much more flexibility than any other traditional product. I mean, because you can make it change with the client's
Sure.
needs.
Absolutely.
Before we go today, I do want to show you out here on the website, if you go to producer resources and training, there's some great webinars. So if you're new to the IUL world and just want to build your knowledge, this is a great resource. If you go under Index Universal Life, the presentation that I did on Saturday was a combination of the IUL 101 and the IUL flexibility. So I basically took the highlights from those 2 presentations and put them together. But those are 2 webinars that are very helpful. And then also, if you want to work a little more on the illustrations, there is IUL illustration demo out here and IUL illustration loan switch demo. The loan switch demo talks about loan switching, which we didn't cover today, which is not really important. But this particular illustration or this webinar actually really talks about building the LERP or the cash accum or cash flow illustration. So it will help you even if you're not interested in the topic of loan switching. So good resource here for more information. You all have my number, you have my email. If you don't want to learn how to run IUL illustrations, that is perfectly fine with me. I'm more than willing to run them for you. And I can help you build your case. So if you've done your fact finder and you call me, I can kind of help you put the case together so that you can, what product is best for your client? Is it a combination of products, perhaps? Do we need to do IUL supplemented with term? All of those things are things that we can help you with on the sales desk.
Terrific.
Any other questions today before we wrap up? I'm so glad that our numbers grew and we got lots of people out here. I'm going to turn my camera on for a minute, just to say hi to everybody if I didn't meet you Saturday. And this is David. David, do you have anything you want to add today since you didn't get to do the training? We'll let you do it next time.
I need to make sure I know how to undo unengage the mute button. So now, Sandy, I think that's what's so great about Columbus Life is you have resources like Sandy that is there to help you through this, walk you along, and her willingness to help out. I've just been struck by that. We certainly appreciate your business, and if there's anything we can do, I'm more comfortable by the day with all things Columbus Life. So feel free to reach out to me. But no, this is a great demonstration. I can't wait to get in tonight. I haven't played with the Life Portraits software yet. I did many years ago, but I can't wait to get in there and play with it tonight.
So I'm going to put if I can get to the right screen here, put my contact information out here. It's being complicated. See if I can change it. I have a screen that's jumping into my way, a little pop-up screen. So it's Sandy Beheimer. I can't even see what I'm typing. Sorry, there's like a pop-up screen here. And one more for the phone number. The phone number is for the sales desk. If you're calling in from your local area code, it should automatically put you through to me if I'm available. And if I'm not available, you'll get one of my teammates who can also help you with pretty much anything that you would need. I think I got it all on here. So thanks again, Johnny. It was really nice to meet you virtually today for the first time. And we look forward to helping each and every one of you.
All right. Thank you very much, Sandy. That was great. That was an excellent training. So thank you very much. And thank you, David, for joining us today as well.
You got it, Case. Thank you.
Yeah, really appreciate your time. Thank you. Thank you very much.
All right.
Have a good day.
Take care.
Thank you.